guys, in this video, we're going to talk about the short strangle strategy. Now, the difference between a short strangle and an iron condor is that it's actually two less legs to the strategy, but we are not defining our risk. With an iron condor, we create a range, but we define our risk. We put protection on with those long puts and the long calls on either side of our short legs, and creating a defined risk strategy, and that's our protection. So we cannot lose more than the credit received minus the width of our strikes. But with a short strangle, we are undefined, and we're going to go into that right now. So just to create a plain old short strangle strategy here, and to create a range by which we think, for this example is going to be CGC, create a range where we think CGC will stay in this expiration date. We'll go ahead and we'll start off with selling a short put. So we'll go ahead and we'll sell this $20 or the 20 strike put right here. You can see that we're collecting 86 cents. And then we're going to create a range, and we're going to go ahead to the call side, and we're going to actually sell another strike here. So we're going to go ahead and we're going to sell this 30 strike right here on the call side. So you can see that we have created a range. Oh, sorry. You can see that we have created a range. So that's where all this green is here. So our break evens are actually outside of both of these short legs, and that's just adding or subtracting the credit received from our short strikes. Okay, so the max profit is going to be 136. So that's what we can make. We cannot make more than what we sold something for. Okay, so this is our max profit. We're going to go ahead and subtract that from 20. That's going to give us our break even here. We're going to add this to 30 on our call side, and that's going to give us our break even on the call side. Now, what happens because we are unprotected? What happens if the stock actually breaches our short strike and goes below our break even? Well, to the downside here, the most that we can lose, or our max loss, if the CGC goes down below our break even, is that now we are on the hook for 100 shares of CGC at $20 minus this 136. Okay, so that's basically, you want to do this in something, especially if you're going to play pretty tight like this. This is where we are right now. We're currently at the 24 delta and the 17 delta respectively. So if you're playing very tight like this, when you expect to lose $3, you're right at $3 on the put side. You want to play something that you're fine with just owning stock in, because your risk to the downside is going to be you own CGC at $20 minus this 136. And for some of you, that might be fine. Well, it's perfectly fine. I don't mind owning CGC here. Now, for our upside risk, though, if CGC just busts through this 30 and I bust through our break even, then what is going to be our max loss? Well, on our put side, we get assigned shares, but on the call side, we actually have to buy shares and then sell them back. Okay, so if CGC comes up here to $35, well, guess what? We now have to purchase 100 shares at that $35, and then we have to sell them back for $30 a piece, and subtracting by that 136. So that's our credit received. So we do get to subtract that 136, but we're still buying back here at $35, and then we are selling back at $30. So that's our max risk to the upside. So that's if we break through that short call and our break even there. And that's why our max loss says it's undefined, or it's infinite, because technically CGC could just keep on going and going and going and going up, and we don't really know exactly where our loss is going to end up or what it could be, because technically it could just keep on going and going. So we don't really know. But anyway, that's all a short strangle is. It's a very common strategy, especially if you're trying to stay delta neutral. So usually people would come in and say, okay, I got 24 delta here. I'm going to try to sell something close to it. And they would sell this 26 delta here. And they won't really worry about how far away they are from the strike price. So if there's a little bit of skew or something like that, I mean, you wouldn't really worry. Like, you can come out here, like say there's tons of call skew and your 20 delta was down here at 35. You would just go ahead and sell this, even though your actual dollar amount from the strike price is not symmetrical to the put side, right? But you just worry about the delta. So that's usually how people play this. Most of the time, it's 35 or 30 to 45 days out. You're looking for high IV environments. So IV rank 39 in CGC. So this would be an environment where we want to play something like this. And it's basically just kind of keep your delta neutral. And then because you don't know what the market could do in those 30 to 45 days. And you would rather just create a range rather than try to be directional anywhere. And what you're doing is you're giving yourself more theta. You can see that our theta is positive. So each day we're collecting money because we're just playing that volatility contraction and that time decay. So that's all a short strangle is. You just sell a naked put, you sell a naked call, you create a range, and then your max loss to the downside is going to be you're on the hook for 100 shares here. Your max loss to the upside is going to be wherever this stock expires at. You're buying 100 shares there, selling it back at that price or on your short strike. So that's all short strangle is. If you have any questions, feel free to reach out and I will answer them the best as I can. Okay, guys, thanks for watching. Make sure to check us out on social media. We have attached links to our socials in the description, and we also have a swing trading service if you're interested. There's more information in the description below.